activity that is given to us. We are told that Veristar Limited has authorized share capital of G million. The company was founded on the 1st of March 2016. Extract from the statement of financial position for the year ended 28th February 2019. We are given ordinary share capital of 3,500,000, but we don't know how many shares were issued. But under transactions, the first point simply tells us that 35% of shares were in issue at the beginning of the year, meaning that it was an issue on the 1st of March 2019, because that will be the beginning of our financial year. Now, 35% of authorized shares. Under authorized, we're going to have 2 million. Under issued, the first thing we're going to do is to take that 2 million and multiply it by 35%. It'll give us 700,000. Those are the shares that were issued at the beginning of the financial year. So at the beginning of the financial year, 700,000 shares were issued. Hence, we are going to say shares in issue on the 1st of March 2019. It'll be 3,500,000 rand. That will be our share capital. And then we issued 500,000 shares at 500 cents per share on the 31st of March 2019. When you calculate share capital, you will simply need to take that 500 cents divided by 100, which is 5 rand, and 5 rand multiplied by 500,000 will simply give you 2,500,000. And then we issued 200,000 shares on the 1st of March 2019 for 10 rand. So to get our share capital, we'll simply take 200,000 and multiply by the share price. Our share capital will simply be 2 million rand. And then we bought back 70,000 shares. We don't know how much they were bought back. Well, we bought them back at 630. That is how much we paid for these shares. But remember, I said your share capital will always decrease at original cost, and the original cost price of the shares will simply be the average price per share. So we have to calculate the average price per share by taking 3,500,000, adding it with 2,500,000, add it with 2 million, and divide that by 700,000 plus 500,000 plus 200,000. It'll give you average price per share of 5.71 rand, and that is the amount of money that you're going to put in there. So this is the average. This is the original cost of the shares. So basically, we actually received 5.71 rand from the shareholders on average when they bought shares from us. Hence, it makes sense that share capital will decrease at this average price. I repeat, share capital will always decrease at the average share price, because all these shares that were issued to shareholders from the inception of the company were issued at different prices. And remember, share price is influenced by the market and the economy and how well the company is doing. So basically, there's no way that you can issue shares at the same price. Hence, we have to calculate average price per share whenever we buy back shares to estimate the original value per share we received when we sold those shares to shareholders. 70,000 multiplied by 5.71 cents give you 399,700. You put it in brackets because it reduces share capital. It reduces the number of shares that we have already issued. Those 70,000 shares will now be part of authorized shares. They're already in there. They're already part of authorized shares, but they will be moved from being issued shares. So under issued shares at the end of the year, we'll be left with 1,330,000, and that will be the balance of shares at the end of the year. And capital balance will simply be 7,600,300. Now confirm, because if the share buyback is the last transaction, note that the average price per share at the end of the year will also be the same as the average price per share when those shares were bought back. Okay. Now let's quickly calculate profit or loss. Average price, share capital will decrease by the average price, which is 5.70. Now take 70,000 shares that were bought back, multiply them by 5.71 cents. It will give you the value that your share capital must decrease by, which is 399,700. Another account that will be affected, obviously that will decrease your share capital in the balance sheet. Another account that will be affected is bank. This is what we paid. A lot of you seem seem to take this 6,3 and multiply it by the number of shares that were bought back and put it under the ordinary share capital. I said ordinary share capital, you only put the average price per share as the price per share of those shares that were bought back. Now, to calculate the value of the money that we paid, we're going to take the 70,000 rand multiplied by 630. This is how much we have paid, and this has left our bank account. Okay, I left one closing bracket there. Our bank account will decrease and it results in a cash outflow. Now you will realize that we actually paid 0,59 more than the average price per share. I repeat, we paid 0,59 more than the average price per share. I know that with classwork 4, I said to you, you paid more. If you paid more than the average price per share, it means the company made a loss, right? In this case, we made a loss of 0,59 cents per share that was bought back, and there were 70,000 shares that were bought back, and that means we made a loss of 41,300. This loss will be taken to retained income, and it will reduce the value of our retained income. Please, guys, listen to this video, replay it as many times as you can.